reversal patterns, as the name suggests, refer to patterns we often see before the trend reverses to the other direction. So let's dive into each one. So head and shoulders, here you will notice a high followed by a higher high, then suddenly a lower high forms. So basically, it's a sign that buyers or bulls have started to lose control and are having a hard time pushing prices higher. So once the neckline is broken, it becomes a clear indication that the trend is already reversing. And double bottom, so for double bottoms, it signifies that the trend has slowed down. So prices have now met a wall that it's having difficulties getting past. And although most people often think that double bottoms should have higher lows, sometimes having a lower low occur can cause the pattern to be stronger, since the move could have been caused by institutional traders or fund managers trying to make people sell. But generally, the second low should be near the first low, and it could be a bit higher or a bit lower, but overall it shouldn't be too far apart. And then the next one is the rising wedge. So a rising wedge signifies that momentum has already been exhausted. A key characteristic here is that prices are still going up, but it's noticeable that as time goes on, pahina ng momentum. So although sa later lesson pa ito madidiscuss, it's also common to find RSI divergences form whenever you see wedges in the market. So just wanted to note as well that for reversal patterns, usually you'd want to wait for the neckline, the major support, or the major resistance level to be broken first as confirmation that the trend has finally reversed. Also, for the bullish versions of these patterns, the inverse head and shoulders, the double tops, the falling wedges, all you need to do is invert the patterns. And then, so basically, yung head and shoulders, inverse mo lang, yung double bottom, magiging double top. The rising wedge becomes a falling wedge, and so on and so forth. Alright, so on the other hand, we also have continuation patterns. So continuation patterns are patterns you would usually look for if you want to follow the trend. So for continuation patterns, usually, pareho lang naman yung main logic among the different patterns. Basically, in the markets, prices don't move in a straight line. Usually, may ups and downs, and it so happens that for uptrends, mas mahaba yung up moves, and vice versa naman for downtrends. Usually, mas mahaba yung down moves. So, continuation patterns or consolidations need to happen in order to maintain the health of the trend. As more and more people are making money on the current trend, there will become more profit takers who are happy with what they've gained and they want to cash out their profits already. So essentially, the markets will take out these shorter term traders para matitira na lang na holders ng coin are those looking to hold for the long term. If this doesn't happen, yung pag-consolidate, yung shake out ng profit takers, then nagiging overcrowded yung asset, and as more and more people are looking to take profits, usually ganito nangyayari yung mga big drops in the market because nagiging overcrowded na yung trade sa higher price levels. So the different patterns help us identify, one, if the trend is sustainable, and two, where the optimal entries and exits are. So let's dive into some popular continuation chart patterns. So first, we have the triangles. So there are three different kinds of triangle patterns: the symmetrical, the ascending, and the descending triangles. So for symmetrical triangles, these are consolidations where both lower highs and higher lows are forming. Usually, if you want to make a trade, the primary basis is the break of the latest lower high with stops set at the break of the latest higher low. For descending triangles, you're usually met with a horizontal support level with lower highs forming. Here, ideally, you'd want to enter at the break of the latest lower high with the horizontal support as the basis for the exit. And then next one, for ascending triangles. So these take the form of a horizontal resistance with higher lows forming. So among the three, this is the easiest pattern, or sorry, the easier pattern to trade on the long side, since clear na kagad na after magkaroon ng breakout, onti na lang supposedly yung supply sa taas. And also, stops are usually closer to the entry given that higher lows are forming. Then, of course, you also have the Darvas boxes, or basically rectangular consolidations. So somewhat straightforward. Usually the entry point here is on the breakout of the resistance with the exit based on the support level. Among all of these patterns, ideally, you'd also want volume to remain low during the consolidation with the breakout point exhibiting higher volume than usual. So this signifies that institutional holders are still there in the trade and that the traders who sold their shares were mostly retailers or somewhat smaller fish. So the higher volume during the breakout confirms that demand is still strong for the cryptocurrency. And overall, as what I mentioned, you don't need to memorize all of these patterns. In fact, there are other variations and different patterns that you can learn more about. The common denominator among all of the patterns is whether or not buyers or sellers are in control, or whether or not if bulls or bears are in control, and also if the control is about to get shifted to the other side. And that's pretty much it for today's lesson.